I'd like to remind you I'm a certified financial planner. I've been in business over 25 years, and I'm really on a journey to help people with their finances. I've written a book called Beyond Money. It's available at Amazon. It was #1 bestseller. You can see it in my description if you're interested in taking a look at it. You can download it for Kindle. My channel is all about helping people like you with their finances. There's a lot of questions out there that people have every day, and they have no one to turn to. I hope you'll consider subscribing to my channel. Give me a like. If you have a question about this video or any of the other videos, don't hesitate to ask. I'm very good at replying to those in a timely fashion. Today's topic is one that is really important because it's such a large part of our financial lives, and that's mortgages. Mortgages can be a very smart form of debt. Think of them as your home loan. Unfortunately, people make some mistakes. Some are big mistakes, some are smaller mistakes. I'm going to start with a big mistake, and then I'm going to come up with a really good solutions towards the end. So please stay tuned. #1, when you buy your first house, people make a big mistake here. The big mistake when you buy your first house is basing it on 2 incomes if both spouses are working. Bad idea, especially when you have no children. Because if you plan on having children and you're successful, there is a huge gravitational pull for many people to be home with their children. Ideally, many people would like to have one of the 2 parents home with their children full time. However, if you've bought a house based on both incomes, you're not necessarily going to feel comfortable having one of the parents stay home. I think that is a real shame, and I wish it didn't have to happen. Because the last thing you want to do when you have a child after you bought a house on both incomes is downsize. You know, or buy in a different neighborhood. You like your neighborhood. I wish you'd bought that first house on far less than your joint incomes, what the mortgage lender told you you could afford to buy. Okay? Don't take the max. Please do not take the maximum mortgage. It straps you financially. That's the second part. Even if you don't have to downsize, or you can afford to have someone else look after your children, you want to have more money to save, more money to invest, more money to travel with. The house is your biggest expense of your life. Don't overdo it. You can be just as happy, if not happier, in a little bit smaller house or in a little bit different neighborhood. Trust me. There's such a thing as big house, no cattle. That means people can afford all the payments that go with the big house and furnishing it and the big mortgage, as long as both husband and wife are working, doing very well. There might not be any other money, though, left over to save and invest or have fun with. And certainly you're not going to have the option of going with only 1 income rather than 2 if you buy too big of a house. So I'm suggesting you don't do that. Second thing I'd like to talk about is really big issue in financial planning. I do a lot of retirement planning, and one of the things that people are focused on is, how much money do I need when I retire to live on? How much do I have to have saved so that I can afford to stop working or can work part-time? And when we do the analysis, the single biggest factor is, what is your overhead going to be in retirement? Well, it depends. Do we have a mortgage or not? Far and away the biggest issue. From a planning standpoint, ideal planning says, I don't have a mortgage at retirement. Now, everybody can choose not to have a mortgage at retirement by simply downsizing. They've lived in a house for a number of years, they've got some equity built up. They said, well, we're retired now, we got to sell our house and move to something smaller because that's all we can afford. We can't afford to retire and stay in this house. To me, there's nothing wrong with that. But it's not ideal. I want to have an ideal retirement plan. Well, how do we do that? Well, we make sure that we align our mortgage payoff. We retire our mortgage when we want to retire from full-time work. Here's an example. Most couples have bought their house in their 20s or 30s, and maybe they have a family, and maybe when they're 45, they're ready to step up. Buy their dream house at 45, let's just say. They're done having kids, probably. I need some room, making more money at work. Let's get the dream house. And they do that, and of course they always want to max out what the lenders will give them, despite what I'm telling you. And they do a 30-year loan, because the 30-year loan is a much smaller payment than a 15-year loan, because you're paying that payment 15 more years, and allows you to buy a bigger house, more expensive house, I should say. Now, you bought this at 45, 10 years later, you start to have an eye on retirement. Trust me, I'm there. And you start thinking about, what are you going to do? What do you want to do? What can you afford to do? And it all comes down to, well, can we afford to live where we still are in this house? Well, in my example, when you were 45 years old, you took out a 30-year mortgage. Now you're 10 years in. Well, geez, let's see, 30 years, you're thinking 30 plus 45. I still have 20 more years left on that mortgage. I can't be stopped at 65 or 67 when Social Security kicks in its full amount. I still have 8 or 10 years left on that mortgage. I'd have to have a heck of a lot of money saved up to generate income to pay that bill. It'd be tough. So what are your options? Well, let me give you a few options of how you can line that mortgage so that it'll be paid off. The first one is refinance. So let's say you're 55, you want to have it paid off at 67. Did you know you can refinance today and do a 12-year mortgage? It's not just 15 or 30. Did you know that? You can. Now, obviously, if you go from a 30-year mortgage to a 12-year mortgage, your payment's going to go up substantially. Hopefully, you're making that much more income between 45, now you're 55, and you could afford to do that. That's a simple, guaranteed way to get that mortgage retired at 67 when full Social Security kicks in, and get that done. It gives a lot of peace of mind doing that. It's not the only way. Some people are scared to do that because it's not flexible. What happens if that payment's too much? What happens if I need money for my kid's college that I'm trying to help them pay for? Well, I don't really want to take a home equity loan back out of there. That would defeat the purpose. Okay? So that's an inflexible way, even though it guarantees it. A second way you might choose is to make payments not every month, but every other week, making 26 payments a year, which will actually give you one more mortgage payment a year. Just doing that will shave off a year or two off your mortgage, depending on how far in you are. Not a bad idea. The next idea I'm going to share with you is the same concept. All of these are giving more money to the mortgage company, the lender, to shorten your payback time. Let's say your principal and interest payment's $1,500 a month. Round up to $2,000, giving them the extra $500 a month that'll go towards paying down the debt. Doing something like that will also shave off years, months and years off your mortgage. Okay? There's calculators you can use, and I can help you with those if you'd like. Send me a note and I'll gladly help you with that. That you can see, depending on how much you pay off, how fast that will pay down your mortgage. How many years will that shave off? Happy to do that. Good strategy. The thing I like about that is it's flexible from the standpoint of if you can afford it, you can do it. If you can't, you can't. If you're depending on you're getting raises or you're making a bonus at work and that's what you're using to pay it off, you have some flexibility so that if something slowed down at work, you didn't have the money, you wouldn't be stuck having to pay it like you would by shortening your mortgage period to a fixed short-term rate and period. While these are nice ideas, they don't come without a problem. The big problem I see in doing these is you're giving money to the mortgage company, to the lender. And for most people I see and talk to, all their money, you can say all, 90-something% of their money is tied up in two places. Retirement accounts, usually start at their 401k, and their home. Both illiquid places. Don't like that. Most people don't have any liquid money saved. A little bit in savings or checking, but not nearly enough. I would like to see you come up with a liquid fund. Because what happens if you lost your job? You need money. The mortgage lender's not going to give you a loan at that point. So what I'd like to see you do, using my example of rounding up to $500 a month from $1,500, say to $2,000, I believe you can take that money, put it in a separate investment account, and do better than the 4% or less mortgage you may have. Now, it's not guaranteed. So the prepaid mortgage is nice because it's guaranteed. It's almost like having a bond investment. That's what I like about it. It's a fixed investment with a lot of certainty. You know exactly what you're paying off. But I would at least consider rolling the dice with a well allocated portfolio of investments that I might make 7 or 8%, possibly more. And then when I do that, I have this side fund that I'm calling this my prepay the mortgage early fund, okay? Because I can take this money at any time at my discretion to use to pay off the mortgage. So maybe because I make 7 or 8% rather than the 4% down payment if I gave the money to the mortgage company, maybe rather than 12 years waiting until my mortgage is paid off in the one example I used earlier, maybe because I had a higher growth rate, I could afford to pay it off in 10. Or maybe I need that money and it's more important to me, for whatever reason, to use towards my son or daughter's college. Or maybe it's more important to me to use that money for another investment. Maybe I want to buy a condo in South Florida. I have liquid money that's available to me. I like that. That I think can make a higher long-term return, no guarantees, than I can make by paying down the debt on my mortgage. So, in summary for today, make sure you don't take out too big a mortgage relative to your income. Go less. You'll appreciate it in the long run. You'll have more money. You'll be able to either vacation more, furnish the home nicer, retire sooner, invest more often, all these different things if you have a smaller mortgage. Secondly, when you do retire your mortgage, pick one of these things. Okay? If you don't have the discipline to set up the self-fund, by the way, I would do that automatic investment pilot. So I would have the $500 automatically taken out of my checking account into whatever investment account I set up. Okay? If you don't have the discipline to do that, then I would for sure consider just rounding up every mortgage payment, or if I want even more guaranteed discipline and love the safety and guarantees, I would do the shorter mortgage. Refinance. Get the terms that match up with your ideal retirement age. So you will have the option, the freedom to potentially stay in the home where you raised your family and not have to move because you can't afford to live there during retirement. Thanks a lot for listening. I hope you'll subscribe. Check out my other videos. Let me know what you think. Let me know if you have any other videos or any other topics you'd like me to cover, because I can help you with a number of different things. If you just let me know what you'd like to hear about, I'd love to help you. Appreciate you listening. Have a wonderful day.